Welcome to the Investing Show. I'm Simon Lambert of This Is Money. Joining me now in the studio, I've got Alex Davies of Wealth Club. Alex, welcome to the show.
Thank you, Simon.
We're here today to talk about VCTs. Now, I think VCTs are one of those investments that are fairly mysterious to a lot of investors. Yet, in recent years, we've seen a flood of money coming into them, and venture capital trusts, to give them their full name, have been closing their doors early and saying to investors, sorry, we're sold out, effectively. What's going on here?
Well, the main reason for the popularity is all the changes to pensions. So if you are a high earner or have got more than £1 million in a pension, you can either put in a lot less than you previously could or nothing at all. So that's one of the main changes, and there's also been a general crackdown on wealthier investors. So buy-to-let is now much harder to make money out of because of the tax situation. If you have a large investment income, again, you're probably going to be taxed much more on it thanks to the new dividend tax. So really, all the traditional places, higher net worth, wealthier people would have saved, such as pensions, etc., buy-to-let, they're all being closed off, and VCTs are really the last, or one of the last, decent places for them to save simply and tax efficiently.
So you've got people bumping up against the lifetime pensions allowance, for example. I think a lot of people think £1 million in your pension pot is an awful lot of money, and then all of a sudden they realise that it actually won't buy that much income.
That's right.
You've got annual allowance changes affecting people, especially higher earners with final salary schemes, or those who might have been entrepreneurs who haven't saved into a pension and then suddenly decide they want to put a load of money in there and realise that they can't. And they're attracted by the tax benefits of the VCT. But what exactly are the tax benefits of the VCT?
Okay, so when you invest in a VCT, you get 30% income tax relief. And so that means if you put £10,000 in, you'll get up to £3,000 back in tax relief.
And you can claim that on your next tax return.
That's correct. And you also get your returns, which come mostly as dividends, are also tax-free. So that's a very attractive benefit to a lot of investors. In terms of how much you can put into a VCT, you can put in up to £200,000 in per year, which is a very sort of high investment limit and attractive to a lot of people.
And then are the profits that you make, any capital gains that you make, tax-free?
Again, that's tax-free, but in reality, nearly all the profits are distributed as dividends.
Right. So it's not the case that you're going to be sat there and you've got some big profit that you've made in 5 years' time or so. It's more likely that money will have been distributed to you over the course of the investment.
That's correct. So normally the net asset value of the VCT should stay roughly stable, and all the profits paid out, or most of the profits paid out as dividends.
So if someone looks at a VCT and goes, well, look, over 5 years the net asset value is hardly moved, that's not what they should be looking at performance-wise.
No, that's not. And actually, VCTs have had incredible performance over the last 10 years. They've outstripped significantly, for example, the FTSE 100, and have typically been paying out 6, 7, 8, 9% tax-free dividends each year.
And obviously, despite the attractive tax benefits, which presumably is one of the key drivers behind a lot of people looking at VCTs, you should never invest just for the tax benefits of an investment, should you? You should be investing because you actually think that investment is worth having in itself. Where are the VCTs investing, and why is that attractive to people? Okay,
well, actually, the investments that come out of a VCT, to look at the most successful ones, for example, Zoopla was the first £1 billion company to come out of a VCT. Secret Escapes was another. Virgin Wines is a VCT company. So there's an awful lot of decent companies that have come out of VCTs. So it's not only the tax benefits, but obviously these were young companies once, so that tax benefit really helps to soften the risk of investing in a younger company.
And are the companies that the VCTs invest in mainly unlisted companies, new unquoted companies?
They are either unlisted or quoted on AIM, and yes, they are young. They are younger companies, so when a VCT makes a new investment, that company typically would have to be under 7 years old. But most VCTs, obviously, they've got an existing portfolio of companies, and those companies can have been around for a long time. So you're actually getting access not only to new investments but a lot of very mature companies.
And with the VCT sort of investment process, is it the case that a lot of those VCTs are looking not just to put some money into a company and then sit back and wait for the returns, that they're also in many cases looking to actually get involved in that company in some way, bring some influence to bear, help with the sort of senior management team?
That's correct. In many cases, a VCT manager will sit on the board of the company and they'll be doing everything they can to help with strategy to drive that company towards a successful exit.
And what's the benefit of that to the company itself?
Because it gives a company's there to make profit and lots of profit, and it hopefully provides professionalism to the company and gives them a faster route to exit. So their exit is in a way being managed by experts.
Yeah, so
they're experts in managing their business. The VCT manager is an expert in getting the best price for that business.
So the idea would be that they sort of help to inject a bit of the expertise that they've had with other companies that have, you know, sort of scaled up or done really well.
That's correct, yes.
And with the companies that are offering the VCTs, how much do they look to raise each year, and why do they only raise a certain amount and sort of shut the doors early, so to speak?
Okay, well, each year VCT they could be asking for investment of anything between, say, £15 million, and the largest raise this year is coming from Octopus, and they're looking to raise about £200 million. And once they close, then they look to invest that money over the next year or 2 years.
And does limiting the amount of money that they have coming in help with the investment process in a way?
I think it does, because you raise the money and then you get on, and you raise that money in a limited period and then you get on and invest that money.
And presumably, as a manager, you know, investing in smaller unquoted companies, you wouldn't want an unlimited amount of money coming in, as you might end up with a traditional investment fund, for example, because there's a limited number of opportunities for you to be looking at.
That's it, indeed. There are a limited number of good opportunities, although I think these days there are a lot of opportunities around, just because if you're a small business, the banks are very unlikely to lend you money. And you also just, I think entrepreneurialism is much more in fashion these days. You've got all these sort of tech hubs around the country. You've got a lot of really good university spin-outs. So I think there are a lot of opportunities.
And you guys at Wealth Club as a business, you essentially, you know, look for the opportunities for your investors and help them to find, you know, good VCT opportunities and also other investments as well. What are the companies out there doing this and running the VCTs, and what do you look for when you're looking for one that you think, yes, this actually stands out as a good idea?
Okay. In terms of the companies around, there's about 15 or so companies that currently manage VCTs. When we're looking for companies ourselves, I think first the very important thing, if you're going to invest in a VCT this year, you should probably almost certainly spread your investment over a number of different providers, because VCTs are more risky. So when we're looking for companies, we're looking for VCTs, we're looking for people who've got a good track record, they've made lots of exits, they've paid good dividends, we look at charges, and I think ultimately it's, if I'm going to invest in a VCT this year, which one or which ones would it be? So those would be the ones that come up as our principal recommendations.
And that is obviously your intent. You do invest into these VCTs
yes,
as well?
Yes, that's right. I invest and I'm exactly the same position as many of our clients. I found suddenly I couldn't put nearly as much as I wanted to into a pension. I've also had buy-to-let investments, which have become a lot less profitable, so I started looking at VCTs.
And in terms of the kind of companies doing the VCTs, I know that going back some years there was a bit of a split in the activities they did. Some of them would be investing in these early stage companies, the growth companies, the ones they thought could scale up. But then others were investing in other assets, mainly for sort of the income yield.
Yes.
Has that changed nowadays?
It has changed, because since 2015 the rules have become stricter, which means all new investment has to go into younger growth businesses. before you could go into business with a lot of asset backing. You could also do management buyouts, which is arguably a lot safer and could pump up the yield. That's no longer allowed. But when you invest in a VCT, you are obviously investing in all the existing investments. So there's a lot of there's companies like Mobius, for instance, who are a big management buyout VCT. Northern, Maven, etc. They've got a lot of the traditional type of investments, but all their new investments will be growth orientated. And then on the other side, there's companies such as Octopus Titan, which has always been very much a growth VCT, and Pembroke's another one, and they're investing in, Octopus Titan was invested in Zoopla, it invested in company SwiftKey, which it recently sold to Microsoft reportedly for $250 million, and another one they've sold to Amazon, another to Twitter. So it's that sort of thing in Octopus Titan, and Pembroke, again, more growth orientated companies. But now all new investment has to go into similar sort of things.
And I suppose also we should explain to our viewers about the practicalities of it, shouldn't we? Because what you're doing when you invest in a VCT is you're buying shares in a trust, aren't you?
Yeah.
And so you have a stake in all of the assets that trust owns.
That's correct, yes.
And then that, obviously, you've got the element where the share price could be different to the net asset value.
That is true, and in most cases, the share price will be below the net asset value because there isn't a huge market in second-hand VCTs. Having said that, nearly all the VCT managers will offer times in the year where investors can sell their VCT shares back to the manager, usually at a sort of a 5 or 10% discount.
And in terms of people investing, it's any investment that has any form of tax benefit to it runs, you've got that end of the tax year deadline, haven't you? Now, someone watching this now, we're sat here, it's, the middle of September, might feel like the middle of November outside, but it's actually only the middle of September. Yeah. And they might be thinking, well, I've got ages to go. That's not till April. I've got till the classic sort of investor deadline of, well, I'll do it on the 4th of April kind of thing. But you don't want to be leaving this late, do you?
No. Well, there's a few reasons for this. First, a lot of the good VCTs sell out very quickly, and last year was a real case in point. An awful lot of VCTs had gone by February, so you missed out. This year, there's something called the Patient Capital Review, which is going on, which is looking at how to put some development capital into sort of fast-growing businesses. And ironically, there is some talk that VCT tax relief might be tinkered with, or the type of investments VCTs can invest in might be restricted further. So I'd say if you're definitely going to do a VCT this year, you're probably much better off doing it now rather than leaving it to, say, the budget where the rules might change.
Because presumably the idea would be that you'd think the rules would change moving into the future rather than retrospectively.
That's right. That's what normally happens. Yes.
Yeah. Okay. Alex, I thought that's all we've got time for. Thank you very much for joining us. Thank you very much for explaining the world of VCTs to our viewers. Thank you very much for watching. See you next time. Goodbye.